Okay, I know. Interest rates, monetary policy sounds like the start of a nap, but hear me out. This is the institution who decides how much your mortgage costs. This is the voice you'll hear before the economy turns. This is the one institution that's literally designed to be apolitical, and all they care about is data, data, data. The other day, the Bank of Canada held a press conference where they admitted that Canada's economy is in structural trouble. So let's break it down because it's more serious than it sounds. Now, I've watched the entire press conference, so you don't have to, but when it comes to this kind of communication, I strongly recommend that you view the whole thing because economics under the gentlest circumstances is complicated, let alone with all the turbulence that Canada has been experiencing lately. Let's get into all of this. Just before we do, if I could quickly ask you to like this video and subscribe if you enjoy the content, as it'll help this video be seen by more people so they get the nuanced message. So the core of the message is essentially that Bank of Canada just cut rates for the second time in a row, but they're also signaling something deeper, that this is not just a slowdown, but rather a structural shift and monetary policy is reaching its limits. We'll discuss what that means. Let's first have a listen to what the governor is going to say.
Today, the bank lowered the policy interest rate a further 25 basis points, bringing it to 2.25%. This was our second straight cut and reflects ongoing weakness in the economy and contained inflationary pressures. Today, we also published our outlook for the Canadian economy. Putting those two things together, we have four main messages. First, U.S. tariffs and trade uncertainty have weakened the Canadian economy. We expect very modest growth through the rest of the year, with some pickup in 2026. Second, while this weakness is restraining price increases, the trade conflict is also adding costs for many businesses, putting upward pressure on inflation. We expect these opposing forces to roughly offset, keeping inflation close to the 2% target. And third, to support the economy through this period of adjustment, we have lowered our policy rate by 50 basis points over the last two meetings and by 100 basis points since the start of the year. Finally, the weakness we're seeing in the Canadian economy is more than a cyclical downturn. It's also a structural adjustment. The U.S. trade conflict has diminished Canada's economic prospects. The structural damage caused by tariffs is reducing the productive capacity of the economy, and it's adding costs. This limits the ability of monetary policy to boost demand while maintaining low inflation.
Now, first of all, when they say 50 basis points, they mean 0.5%. Canada's policy interest rate is now at 2.25%, which, if you're not following this closely, might not sound like much. But as the governor just said, this is the second cut in a row, and it marks a pretty clear shift in tone. The Bank of Canada is no longer in hold steady mode, it's in support mode. And the reason for that is fairly straightforward. The economy is weakening and inflation is no longer a fire that needs putting out. Now, people usually ask, what's the right interest rate? But there is no magic number, unfortunately. There is no ideal rate that works across all situations. It depends entirely on what's happening in the economy at that time. If inflation is running wild, you raise rates usually. If growth is collapsing, you cut them. And I'm wildly oversimplifying here. A good rate isn't defined by the number itself. It's defined by whether it's doing the job that it needs to do. So what's happening right now? Growth has been sluggish, borderline recessionary in some quarters. We discussed last quarter in a past video, actually. Check that one out if you're interested. And the inflation data has cooled enough for the Bank of Canada to act. Prices aren't dropping fast, but they're not running away either. Core inflation has hovered around 3%, but that momentum is fading, and broader inflation expectations are drifting back toward target. That's why the Bank of Canada feels comfortable cutting the rate again. They see inflation as contained, and they want to give the economy a bit more breathing room. But, and this is very important, they're also saying that this is not just a short-term blip. They're using language like structural adjustment, which is code for we're not bouncing back quickly. That's the real damage here. The US trade war has shifted Canada's economic path, and monetary policy, things like rate cuts, can only do so much. Let's go further. This is one of the most important and honest statements in the entire press conference, in my view.
For many months, we've been stressing that monetary policy cannot undo the damage caused by tariffs. Increased trade friction with the United States means our economy will work less efficiently with higher costs and less income. Monetary policy can help the economy adjust as long as inflation is well controlled. but it cannot restore the economy to its pre-tariff path. Above all, the Bank of Canada is focused on ensuring Canadians continue to have confidence in price stability through this period of global upheaval.
Okay, let's unpack that. Monetary policy is the set of tools central banks use to influence things like borrowing, spending, and inflation, primarily through adjusting the base interest rate. Lower rates make it easier to borrow money, which can stimulate growth in the economy. Higher rates will do the opposite. They cool things down when inflation is running too hot. But monetary policy cannot fix everything, and it especially cannot fix this. When a country like the US imposes tariffs on Canada, essentially taxes on Canadian goods, it changes the structure of the economy itself. Suddenly, Canadian businesses are facing higher costs, disrupted supply chains, and more uncertainty. This is not a temporary slowdown that rate cuts can jolt back to life somehow. It's a long-term shift in how trade works. If a steel mill closes because it lost US contracts, no amount of interest rate tinkering is going to bring those customers back. That's not a demand problem. Is just a reality problem. What the Bank of Canada can do now is soften the landing. They can lower rates to help households and businesses get through the transition. They can try to limit the spillover effects, keep inflation under control, make borrowing easier, reduce the financial strain, but they cannot reverse the damage. That's more a structural problem. That requires new markets, new investments, even new industries, and that's beyond the reach of rate cuts or the central bank as a whole. Now, here's why I think people should still trust the Bank of Canada. It's not just that they're full of magical economists with PhDs, though they are. It's because this is the one institution in the country that sees everything. They hold the majority of the macroeconomic data. They run the models. They see the household debt levels, the business confidence surveys, the trade flow data, the wage growth, the credit conditions, all of it. And they don't just see the data, they're required to act on it. There is simply no other entity in Canada with this level of economic insight. Not the finance ministry, not private banks, not think tanks, certainly not political parties. So when they say we can't undo the damage, but we can adjust, they're not spinning anything. That's the reality of their mandate. Their job is to maintain price stability, not fix trade wars. And in a time of global upheaval like we are in right now, having even one institution that you can rely on for clear, nonpartisan analysis is actually a massive gift. Let's discuss the part that upset me the most the other day when I was saying that I even dreamed about it.
U.S. trade actions are having severe effects on targeted sectors, including autos, steel, aluminum, and lumber. At the same time, household spending was resilient in the second quarter, with strong consumer spending and a pickup in residential investment. The labor market is soft. Employment gains in September followed 2 months of sizable losses. Job losses have been concentrated in trade-sensitive sectors, and hiring has been weak across the economy. The unemployment rate remained at 7.1% in September, and wage growth has slowed.
Now, 7.1% unemployment rate is high. There's no way around this. That's 7.1% of the labor force actively looking for work and not finding it. Behind that number are real people, families under pressure, mortgages under strain, young workers applying over and over and over with no reply. Now, historically, Canada's unemployment rate tends to hover lower than that during stable periods. For much of the 2010s, it was sitting somewhere between 5% and 6%. And during the best year, say 2018, the golden year, before the pandemic, it even dropped down below 5.5%. So yes, 7.1% is elevated. This is what upset me. And if we compare internationally as well, some countries have recently been doing better. The US unemployment rate, for instance, has been closer to 3.8, 4.2% in recent months, though they've had their own wage and inflation tensions to deal with. European countries are more varied. UK and Germany are lower than this. Spain is higher, but 7.1% is still toward the rougher end of the spectrum for a high-income economy. Now, is there a perfect unemployment rate, a magic equilibrium number? Not really. Economists sometimes talk about the non-accelerating inflation rate of unemployment, which is the lowest unemployment you can have before inflation starts rising, but that number is not fixed. It shifts over time depending on productivity, demographics, global conditions, and even immigration policy. What is clear, though, is that 7.1% means pain, especially when wage growth is also slowing, which it is, as they said. If we were seeing strong hiring, resilient wages, and people moving easily between jobs, that would be one thing. But that's not the picture here. This is a soft labor market, as the governor calls it. And just to explain that term, when economists say soft labor market, they don't mean polite or gentle or sweet. They mean weak. It's a polite way of saying there aren't enough jobs. Employers are cautious, hiring is slow, and the balance of power shifts away from workers and towards employers, towards stagnation, basically. Now, I'll be honest, this part really gets to me. I do have a soft heart. I think about the people in these trade-sensitive sectors, steel workers, auto workers, folks in lumber mills, who've done everything right and are now being told that the economy is reconfiguring and they'll just need to adjust somehow magically. That's cold comfort when the job you've done for 20 years just vanishes. So yes, it's good that household spending was resilient in the last quarter. I'm very happy for that. And that there was a bit of a bump in residential investment. That's nice too. But we can't ignore what's happening underneath the surface. Job losses, slow hiring, and a growing sense of economic vulnerability. And 7.1%, well, just a number on a page, is something I actually think we should all take seriously. So it might seem striking that in all of this, the Bank of Canada is emotionally restrained in its communication. That's by design. It's a technical institution, not a motivational speaker. But beneath the calm tone is a very serious message. Canada is being asked to absorb a deep economic shift, and many of the tools Canada has relied on in the past are not going to work the same way this time. This is not just a slow recovery, it's a reconfiguration that's needed. A whole set of industries, auto, steel, aluminum, lumber, are taking hits they might not recover from in the same form. That means job retaining, regional economic pain, and a long period of adjustment. And the central bank is saying very clearly, we'll support that transition, but we can't stop it. That's not something everyone wants to hear, but I do respect the clarity. So what do we do with all of that knowledge? I think we have to stay alert, we have to stay informed, we have to trust the data, and we have to trust institutions, not because they're perfect or because they never make mistakes, but because they're rigorous. Because they're operating from data, not from political mood or feeling. If we want this transition to be survivable, not just for the economy, but for the people living inside it, we need analysis, not slogan. That's why I follow this stuff, and that's why I'll keep breaking it down for you. So where does this leave us? The Bank of Canada has made its move, cutting rates again, offering support where it can, but it's also been honest about the limits of that support. This is not a quick fix. It's a long adjustment with real consequences for real people. And I think it's worth paying attention to what they're actually saying, not just because it affects mortgages or savings, but because it affects Canada's trajectory as a country. If you made it this far, thank you. I know this wasn't the most sensational topic, but it matters a huge deal. It matters because this is how economies really shift, how lives are impacted, and how trust in institutions is either earned or lost. Let me know what you think in the comments. Do you agree with the Bank of Canada's cautious approach, or do you think they should be doing more? I'd love to hear from you in the comments below. And if you found this breakdown useful, subscribe for more clear, grounded analysis on the economy, trade, and how these forces actually play it in the real world. No jargon, no panic, just reality delivered calmly. Thanks for watching. I'll see you in the next one.